Hello, I'm Mark Patton. Thanks for taking the time to attend this workshop. In today's workshop, I'm going to talk about our flex strategy. And in particular, this presentation or workshop is designed for those investors who want to take a little more in-depth look at the strategy. We have two different workshops that we do. There's another one that's more of an introductory that's available via our workshop replays. And again, this one's going to be a more in-depth look, really kind of targeted toward those investors who might be a little bit more advanced and want to understand a few more details about the strategy. So with that, let's dig in. All the content that we're going to look at during this workshop is all available via our website, so you'll be able to go back and take a look at this at your own leisure if you like. So under the Why Patton link, we have some basic information about our flex strategy. So let's just take a quick minute there and start here. So as a reminder, it is what we call a hedging strategy in that it is maintains both long and short positions at all times. So it's 100% U.S. stocks. Again, it's a hedging strategy where our goal is to profit from some positions when they go up and profit from other positions when they go down, hence making it a hedge. It's all built around principles of behavioral finance, which means all stocks are selected based upon these various principles, really designed to take advantage of other persons or other investors' poor human behavior. We'll talk about that a little bit more in just a moment. It's a rules-based model, meaning that every decision in the strategy is all done by a computer program that I created. So I spent 4 years doing research on data going all the way back to 1963 and built a set of rules that dictate every transaction in the strategy, every stock we buy and sell, short and cover, the size, and so forth. The goal is to produce uncorrelated performance, meaning that we produce performance that doesn't always go up and down at the same way at the same time as everything else in a portfolio. We've clearly demonstrated that there's both good and bad. Fortunately, there's far more good than there is challenging, but it does come with its pros and cons. And then the last is that it's been validated by research. We've got research, as I mentioned, going all the way back to 1963, testing this strategy the exact same way that we implement it today is the exact same way that it was tested every single day going all the way back to 1963. Let's just briefly talk about human behavior and some of the things that we believe about human behavior. And again, a behavioral-based investment strategy, which this is designed to systematically take advantage of other investors' poor human behavior. So what we mean by that is that we believe that human behavior does impact stock prices. Longer periods of time are more likely to be impacted by fundamentals of a company. Shorter periods of time, we believe, are more likely to be impacted by human behavior. So that means that markets are not always efficient, investors are not always rational in their decision-making process, and stock prices are not always perfectly priced, which means we've got an opportunity to profit from this. Number two is that human behavior is repetitive. We recognize that human behavior is not always exactly repetitive when it comes to investment decision-making because you have so many investors all coming together in one place. But we do believe that investor behavior shows signs of repetitive nature over time, and that's what we're here to take advantage of. So we've got a strict and static or unchanging rules-based strategy, meaning that, as I mentioned, I wrote a computer program that is making every decision about what positions are in the portfolio and so forth. We stick to that. It's unchanging, so I don't change the computer program or the decision-making process because we might be in a bull market or a bear market, or I think that interest rates are going higher, or I think that we're going into a recession. We don't change based upon any of those things. It is a static process that was tested the exact same way every day back to 63 and implemented the exact same way since its launch in January of 2010. We do believe that there are pricing inefficiencies resulting from this human behavior, and we believe these pricing inefficiencies will persist because there's no perfect way to remove them from the marketplace because human behavior is not exactly the same all the time. You can't systematically remove that inefficiency from the marketplace. That gives us a perpetual opportunity, we believe, to take advantage of these inefficiencies to profit going forward. And then the last one is that profiting from behavioral-based strategies requires accepting risk. So again, since human behavior is not exactly the same all the time, we're not going to get every transaction right, of course, and we're going to have our good and bad days and good and bad weeks and good and bad months and so forth. So it comes with taking risk, but we believe that this strategy stacks the odds odds very meaningfully in our favor based upon the decades of research that we have going back to 1963. So with that, let me just check my agenda and make sure I stay on course. Let's take a couple minutes and look at the disciplines for selecting the long and short positions. So we have a presentation page on our website. You can actually access it also from the page that we were just on. It does take a moment to build the data. It's calculating a lot of data here in the background that'll be prepared for us. I'm going to jump over to the Flex Strategy tab here, and I'm going to click on, we're going to talk about the long disciplines. So click on the View Presentation, and this will come up. So let's take a look at the long disciplines briefly. So here we go. So the investment process is to define the universe of stocks that we're going to select from. That would be the 500 stocks in the S&P 500. That's number one. So that is our universe of options. Number two is to enter positions. How are we going to buy these stocks? And so what we're looking for is to enter stocks amongst the group of 500 stocks. We'll have 50 to 60 stocks typically, and we're going to take a contrarian view, which I'll illustrate in just a moment. And then you've got an exit strategy. How do we get out of these stocks? And our goal is to eliminate the losing positions, again, which I'll illustrate in just a moment. And then it's all about building the portfolio. How do we then construct this by position size? How big of a position do we take? And how do we balance between longs and shorts? And all those decisions are also made. So that's kind of the investment process. So let's talk about those long disciplines here. So the universe for the long stocks, as I mentioned, are the 500 stocks in the S&P. So what that means, we will only be long stocks that are S&P 500 stocks, period. Those are the only candidates for the portfolio. Now, we're not going to own all 500 stocks. We're going to own somewhere between 40, 50, 60 positions or so, typically 50 to 60 positions. Here's how we then enter those positions. We monitor the 500 stocks in the S&P 500. The green line is designed to theoretically represent the market going higher over time. Of course, it doesn't look exactly like this. This is theory, but the green line is designed to represent the market going higher over time. And the blue line is designed to represent an individual stock going higher over time. It's simply designed to illustrate that an individual stock is more volatile than the market averages. Simply because there are 500 stocks in the market average, you'd expect it to be less volatile because it's a blend of 500. An individual stock will be more volatile, more likely. So we're going to monitor the 500 stocks in the S&P 500, look for those that are moving higher with the market, as illustrated here, and then what we're going to wait for is a period of short-term downside relative volatility. We're looking for a short window of time because we believe that's more likely to be emotionally driven, not all the time, but it's more likely to be emotionally driven. So we would look for short windows of time where the stock has dipped relative to everything else. It's a contrarian view. We're going to step up and buy when other people are selling because we think this presents us with an opportunity to buy the stock at a lower price and a discount relative to what we might have otherwise paid for it. So that is the theory on the long side. That's how we enter positions. That's how we buy stocks. So, does it always work? And the answer is, of course not. I wish that it did, but it doesn't. So let's talk about how we sell stocks. The sell side is focused entirely on identifying losing positions, and we're looking at longer periods of time. So this green line is designed to represent an individual stock going higher over time. The blue line, again, is designed to represent an individual stock going higher over time. But when you look at longer periods of time, volatility starts to come out. Hence, the blue line is a little less volatile than it was in the graph you saw before. So when we look at these longer periods of time, some volatility comes back out. But what we're looking for is over here on the top right-hand side is that we're looking for a period of time when the market continues to go in an upward direction and the individual stock starts to underperform or decline relative to the rest of the market. And what we're going to do is we're going to wait for enough time to pass because we don't want to sell a stock just because it has some downside volatility. We've already concluded that we believe that would just be kind of noise in human behavior. But what we want to do is wait for a stock to have a period of longer underperformance. That's an indication of more people selling the stock than buying the stock over a longer period of time. That to us is an indication there might be something fundamentally wrong with the company. We never know for sure, but we're going to use this as an indication and we're going to exit the stock when enough time has passed and the underperformance is big enough. Those are the two criteria that we're looking for. That's how we exit stocks. If the stock continued to go higher and beat the market, then we're going to continue to own the stock. So that gives you a little insight into how we select the long positions. Again, S&P 500 stocks are the candidates. We enter them during periods of short-term downside relative volatility, and we sell them during these longer-term corrections. So that's the long side of the portfolio. So now I'm going to switch gears, and I'm going to talk about the short side of the portfolio. Completely different aspect of the strategy, but similar in nature as far as the strategy. We'll talk about that. So under short disciplines, let's click on View Presentation. And let's take a look at what these disciplines look like. So here's the exact same investment process. Obviously, we have to identify our candidates, how we get in and how we get out of these positions, and then how we build the portfolio. Let's talk about the short positions and the candidates for the short positions. They are not the S&P 500, although they overlap a lot. There are 500 stocks that we're going to use as candidates. There are three criteria that we have identified, and we look for those on a quarterly basis. So on the first day of every quarter, we look for stocks that meet these three criteria. Number one, they have to be in the larger portion of market cap. That means size. So market cap is the size of the company. So we're going to rank all stocks from biggest to smallest and cut the list in half and only take the larger half of market caps. Now we've got larger market cap stocks. Number two is we're only going to look at those stocks that are above $15 in price. Lower price stocks tend to be more volatile than higher price stocks, so we're going to stick with the higher price stocks, which will eliminate some of the volatility in our portfolio. So only stocks above $15 in price. The third criteria is we're going to look for liquidity, how much buying and selling is going on in these stocks, and we're going to calculate the last 6 months average trading volume, how much buying and selling has been going on average, and we're going to rank them from the most active to the least active and take the 500 off the top of the list. Those are the ones that are candidates for our portfolio. So we're going to look at only the larger half of market cap, all above $15 in price, and then we're going to select the 500 most actively traded stocks as the candidates for the short positions. So now we have our list of candidates for the short positions. Here's how we enter a position. Again, the market theoretically trends higher over time. This blue line is designed to represent an individual stock trending downward, contrary to the market. So what we're looking for in short positions are stocks in these downward trends. We can always find them. They're out there. Sometimes there's a matter of degrees, but we'll find these stocks in these downward trends. And what we do is we wait for a stock in a downward trend to then experience a period of short-term relative upside volatility. We're looking for the stock to pop up. Hopefully it's more human emotion driven, all right, because what we want this stock to do is to continue to go down longer term. So we're looking for these stocks in these downward trends, a period of short-term relative upside volatility. We think that's a better place to short sell the stock because we want to sell it at a higher price when we enter the position. So the theory is we sell it up here at the higher end of this volatility with the hopes that it continues in a downward trend. If it continues in a downward trend, we profit from this because keep in mind, when short positions go down, we make money. So the goal is to enter the stock during this period of short-term relative upside volatility. Exiting the position is somewhat connected to the entry of the position. So at the point that we enter the position, we have calculated a score for this stock, and it takes into consideration a variety of factors, but one of them in particular is looking at how steep the downward trend of this stock is. The steeper that downward trend, the higher the score tends to be. So what we want to do is short the stocks with the highest score because we think that positions us better based upon our research for profiting. So we're going to calculate a score. Every day that we are short the position, we have time decay built into the score. We ratchet the score down to represent our less like for the stock. Why do we like the stock less? Because over time, stocks tend to go up, not down. So we know that we're fighting a headwind when we are short stocks. So we want these stocks to go down, but we recognize over time they tend to go up and not down. So every day that passes, we have time decay built into the score, ratcheting our score down, representing the fact that we like that stock less and less the more time that passes. is. And if our system finds a stock with a higher score, then we get rid of one position and bring on another position based upon those scores. So the short exit process is really more of a replacement process, looking for better candidates to replace those that we already have in our portfolio. At least that's a big part of it. So that gives you an idea of how we enter and exit our short positions. Again, we're looking for these 500 stocks that meet the three criteria we're looking for as candidates, and then we enter positions on periods of short-term upside volatility, looking for these stocks in these downward trends, short-term upside volatility, enter, and we hope they continue in a downward trend, and then it's a replacement process looking for better candidates. So hopefully, again, that gives you an idea of the disciplines that are used to select the stocks for the short side of our portfolio in the flex strategy. So let's talk a little bit about some risk management. So let's close this presentation and let's go to what we call our strategy portal. So if you're a client and log into our website, you'll have access to this. And I'm going to slide down here to this risk management report and just highlight a few of the things that are in place to control risk. Number one is manager discretion, me being the manager. Very little discretion over the portfolio. We've done research and we have a model, the rules-based model that we stick to. Sometimes I have to make a very, very small amount of discretion, but virtually never, and very little if it is. So we stick to this model. We believe that will position us for long-term success because it removes my emotions from the process, and it is a process that we will stick to that we believe that will produce long-term success based upon the decades of research. Number two is about the security selection and the position size. How big or how much of a stock do we have in the portfolio? We have limits that we cap it at 5% of the exposure in the portfolio. It simply means we won't let one stock become too big in the portfolio, so there are controls in place for that. Very important to understand. We do have we maintain these long and short positions, of course, and we control the exposure, meaning that the balance between longs and shorts. Sometimes we are neutral, and sometimes we have more longs than shorts during certain months, but there are controls in place for that. There's a balance between the longs and shorts based upon volatility. That I really won't get into a lot of detail of right now, but the bottom line is that when we balance the longs and the shorts, the amount of stock we have on both sides, we're going to look at the volatility of these stocks and make sure that they're similar in nature from the average long versus the average short. And then the last is the leverage or exposure. So this one's very important. I will spend a couple minutes on this. Is that the portfolio is leveraged. That means for if an investor puts $1 million into the flex strategy, we could have up to $5 million worth of positions, long and short combined, for each $1 million of capital. So it's got what we'll call 500% or 5 times exposure relative to the amount of capital invested. There are times, though, when we shrink that down and it's based upon volatility. If volatility gets too high, we don't want that much leverage and we automatically shrink down the leverage, and there are controls in place that make that automatically happen. So with that, let me transition and let me show you a graph of that of the control that is in place and how that has worked for us over the course of the past 8 years or so since we launched, 8.5 years since we launched the strategy. So back to the presentation page, I'm going to go down to this report called Exposure and Volatility, and it's going to draw a few graphs for us that I'll explain to you. So again, this is about how much leverage or exposure, those words can be used interchangeably, are in the portfolio. So I'm waiting for this graph to load. It's a lot of data. I'm assuming it's going to load here in just a moment, so I'll be patient with it here. I'm going to pause for a second. All right, so these graphs have loaded here. So up at the top is what we call the target exposure. So our goal is to be 500% exposed, or 5 times the capital. So that's this level right up here, 500%. And you can see there are times, though, when it shrinks down that exposure or leverage, and again, that's based upon volatility. And during the past 8.5 years, there was a window of time that it happened back here in 2015 and 2016 or so, mid-2016, and then over here on the right-hand side, that. It's happened here in 2018 as well, following the spike up in January that we had in the marketplace, and then the sharp fall that happened in early February. All that created enough volatility that we shrunk down the exposure in our flex strategy. So if you scroll down here, this measures that volatility. So this is what we call the strategy volatility, and this orange line is the threshold that we're looking for. That's the first, second, and third. There are actually three thresholds, and you can see that back here in 2015 and 16, how that orange line that it got above that threshold there, and again above the next threshold here, and that would have resulted in us shrinking down the exposure or leverage in the strategy. And then you can see as it came back down, we will then re-leverage and add back to the portfolio. And then you'll see again that it popped above here. Again, this happened in February or so of 2018, and then it went above the second threshold again. So we shrunk down the leverage or exposure here in 2018, and it's finally come back down below some of these thresholds, and we're starting to add back the leverage. So anyway, that gives you an idea of how the leverage or exposure works. But most important thing to understand about this is that there are systematic controls in place. Leverage will add to our return over time, but during tough times and volatile times, we don't want to have too much leverage. So our system automatically reduces that leverage or exposure systematically based upon these statistics, not based upon my judgment, but based upon these statistics. That exposure is systematically reduced to control some risk in the strategy. So let's talk about the research briefly. So I'm going to go back to the strategy portal and talk about research and quality assurance. So if we go down to testing the strategy, I'll just briefly talk about what I've done. So again, this is a computer program that I've designed and tested against data all the way back to 1963. So it's all about that testing. And here's some highlights about how I did the testing process. Number one, I used the data that I used came from a database that the University of Chicago has built, and it's got daily data on every stock that has ever traded all the way back to 1963. It includes every stock, whether or not it's gone bankrupt or merged or taken over. All those stocks are in this database, so it's a very valid database to utilize in a research process like this. Number two is the technology resources. I actually am the one who wrote all the code, so it's a database program. I built those databases using these various other sources. I then wrote all the code that makes all the decisions and did all the testing. So that's a proprietary computer program that I designed. Some keys about the research process is that we maintain a static discipline. So that's important to understand because you don't want to have a strategy that we say, well, it sort of worked during the 60s and 70s, but then we had to change it because it stopped working in the 80s and 90s. None of that kind of stuff. We didn't change it at all. So it's the exact same strategy, disciplines, and rules that we tested every single day back to 63, exactly the way that we launched it in 2010 and exactly the way that it's run today. So a static process. Testing a long enough period of time is very important. There are some bad investment strategies that can actually work during short windows of time. So if you test a short window of time, you might be led to believe that something works, but if you test it over a longer period of time, it stops working. We've tested this over 5 decades worth of data. It's as much data as we can get our hands on to test. We believe that's a long enough period of time to give us an indication that we believe it will continue to work over longer periods of time. And then I guess the last one is about the ability to implement. So it's one thing to have a researched strategy, something you've done research on, but it's another thing to take that research and actually implement it in real time with real money and be able to get the return that the research suggests that you should be getting. So if you've got a research strategy and then you go to implement it in real time, but you can't make it work, then that's no good. The research is no good. We've demonstrated that we can make this work. It's what we call quality assurance. Again, I'm going to jump back to the presentation page. And once it resets here again, I'll go back to the flex strategy. In quality assurance for us, it's a measurement of how closely here we go, quality assurance right here. It measures how closely the actual strategy performance is, clients' real money, is tracking the computer model that I created. So the Orange line on this graph is the computer model, and the blue line is the actual performance of the strategy or fund. And so you can see how closely these two lines move together. Now, there's good news actually is that the strategy has done better than the model, and that's simply because in the model I estimated the expenses and I actually overestimated the expenses. So our performance in real time with real money is actually tracking a little bit better than the model. But the key is that these lines go up and down together. There are going to be certain days when it won't be exactly the same, but over time you can clearly see that these two lines very, very much track themselves. We've demonstrated that we can take this research that I've done and actually implement it in real time with real money. We call that quality assurance. Let me show you now a couple of statistics or a few statistics, and then we'll wrap up. So going back to the strategy portal, I'm going to go to what's called the statistics report, and we'll drop down here to statistics. It'll take it a second to calculate, as you might guess. It's calculating a whole barrage of statistics here. But the first, and these statistics are going to cover from January of 2010 going forward when we launched the strategy. So we now have 103 full months of data. So the number of months going back to January of 2010, we've got 103 months. Something to note here is that when you look at the S&P 500, which is U.S. large cap, when we look at U.S. large cap or the S&P 500, it has been a bull market that entire time. But you will see that it's produced a return. The S&P has produced a return of 212%. That's the cumulative return versus our strategy is up 272% cumulatively during that window of time. So we've outperformed, but I want to point out the fact that, again, it's been a bull market. Even though it's been a bull market during this entire window of time, the S&P 500 has actually had 30 months out of these 103 when it went down. There have been 30 negative months and 73 positive months. So a bull market is not just every month up, of course. It's a longer trend up. So there have been 30 down months. So take note of that. Let's scroll down here for a second. And this is a pretty interesting stat. This shows the average percent change on a monthly basis when the S&P is up. So we take those 73 months when the S&P has moved higher, you'll see that the S&P averaged a gain of positive 2.80%. You'll see that we averaged a gain in our flex of 2.18%. So we underperformed some during the up months. Let's take a look at these down months. So during those 30 months when the S&P was negative, the S&P averaged a loss of minus 2.92%. Our strategy only averaged a loss of 0.85%. So what this demonstrates is that even though it's been a bull market since we launched, it's demonstrated that during these negative months that there's a lot of risk mitigation going on, a lot of reduction of risk in the portfolio, as we've demonstrated there that when the market goes down, we're not going down nearly as much as the market. If we want to get statistical about it, it's about low correlation, low beta, and low R squared. So we can scroll down here just briefly, and you can see that our correlation to the S&P has been only 0.35. It tops out at 1. If two things are 1, they move exactly the same way. If they're 0, they're completely disconnected. Ours is a very low 0.35. Very few things out there are this low, especially things that produce a great long-term return. And some other statistics that sort of show the same thing would be beta. Our beta is low, and the other one is R squared, and our R squared is low without getting into the technicalities. Really just three different numbers that all sort of are trying to represent the same sort of thing about how closely two things move together. All three statistics demonstrate that ours is very low. That is very positive. So we've produced a great long-term return. The question, I believe, for investors is how does this impact a portfolio? And I'll just briefly highlight this in two different ways and we'll wrap up here. So the portfolio impact, we scroll down here and we simply have shown some research on 4 different portfolios. The portfolio on the left-hand side has no Patton in it. So you'll see 0 here for Patton, and you'll see it's in large and small stocks, international stocks, and bonds. So that's portfolio 1 is no Patton. Then you go across here, and the first one has 10% Patton, and we simply took it out of stocks. And then 20% we took it out of stocks, and 30% we took it mostly out of stocks and a smidge out of bonds. So you can see portfolio 1 has no Patton all the way over to 30% Patton. If we scroll down here, we can look at these numbers, but I think the graph is an easier way to look at this. This first dot over here on the far right-hand side is the portfolio 1 that has zero Patton in it, no flex strategy at all. And you'll see it's got the lowest expected rate of return, and you'll see the risk is the furthest to the right, which means it's got the most volatility or the highest risk. When you add 10%, a 10% allocation into a portfolio, you'll see that the risk profile comes down very meaningfully, moving that dot to the left, much lower volatility, and actually very meaningfully moving the dot up to get better returns. And then at 20%, you further do that. And at 30%, yes, the risk starts to come back, but still not as much as even when you had zero. So even at 30%, you're getting still less volatility, less risk with a substantially higher rate of return. So that's the research from 63 to 2010 in real time. If we go here to this performance page, this will show us a line graph of the performance of a super diversified portfolio, cumulative return here. And this blue line is our super diversified portfolio since the launch in January of 2010, compared to what's called the average private client index. You can read a little bit about that in this help section if you click the help, but it's a representative index of other advisors' performance, and you can see how super diversification has worked. So we're very excited about that. Super diversification is our total portfolio strategy, and that return that you're looking at here has been driven very much by that allocation, 30-35% allocated to the flex inside of the total portfolio. So I hope this has been helpful. It's an in-depth look. It's a little bit fast. It's meant for a slightly more advanced investor, I suppose, who at least has interest in some of this more advanced stuff. If you have any questions, please always let me know. You've got my email address most likely. If not, I can pull up my contact information. I guess the easiest thing is you go to our website and click on Ask Patton, and you will be able to put in your name and email address and send this, and this will come directly to me. So I will be happy to address any questions. This workshop is available will be available on our website under Services, and you click on Investor Workshops. This is a list of the upcoming workshops, and here's a list of the workshop replays where this one will be available. And there's that Flex introduction. This again was the in-depth look. So with that, I want to say thank you very much to our clients. Thank you very much for the opportunity to be of service. For those of you who are watching as prospects or just interested, I'd be delighted to talk to you and answer any questions you might have and see whether or not our flex strategy and super diversification would be a good fit for you. So with that, I'll wrap it up. Say thank you very much. Take care.